Hello friends, I am Dr. Chetan Chopra. I am a senior radiologist by profession and by hobby I practice Elliott wave. Elliott wave is a way to assess the stocks, the gold, silver or the general trends in the market. Whether the Nifty or Bank Nifty is going up or it is going down, or it is an up wave in a down wave that we are seeing, or it is a down wave in an up wave. The learning of Elliott wave is very important because it gives you some idea of what is going on in the markets. Now the question comes, why Elliott wave? We all know that technical analysis is that analysis of stock markets wherein it helps us to understand what the markets are doing. Technical analysis consists of many parameters and formations like flags, double top, double bottom, with the help of moving averages, with the help of price volume action, etc., and also the Elliott wave. In my experience, Elliott wave is a very major part of technical analysis, importance of which cannot be overstated. In fact, if I were to say, Elliott wave is almost 80 to 90% of the technical analysis, and rest is the common technical analysis that everybody talks about. However, I understand technical analysis is comparatively easier to understand as compared to the Elliott wave, and it takes months to understand and apply that knowledge correctly. But once understood and taken care of, it can give you lifelong benefit from stocks, metals, etc. Believe me when I say that the effort that you put to learn Elliott wave is worth the effort to generate wealth for future. Now, Elliott wave is very important, but there are many myths and realities attached to it. Elliott wave is a basic structure of price action in a price chart, and it occurs repeatedly in charts. That means to say that a particular price action forming a particular wave repeatedly occurs in charts, in the same chart as well as in other charts. And once you understand the basic structure of the chart of the Elliott wave, then it becomes very easy to apply it in other charts as well as in the same chart in a bigger time frame. It also means that Elliott wave is a part of a bigger wave in a time frame. For example, we can see an Elliott wave on a minute chart, on a 5-minute chart, on 15 minutes, on 1 hour chart, extending to the daily, weekly and monthly charts. But there is a problem. The problem is that these charts do not tell us which wave is going on. So we have to deduce that by looking at the chart that which wave is going on. And if that presumption or guess or deduction is correct, next price action can be anticipated most of the times, and an action of buy or sell can be taken accordingly. This is the basic structure of an Elliott wave in an up direction. It consists of 5 waves on the upside and 3 waves on the downside. So this is called a 5-wave upside, 3-wave downside. Now, the phi wave on the upside is not a straight line. In phi waves, there are three waves which are called motive waves. Motive waves means which move the price. So in this chart, what we are seeing very clearly is that wave 1 is moving the price on the upper side, on the higher side. Whereas wave 2 is a corrective wave to wave 1. That means it retraces or it goes back in price to a certain percentage before kicking up the third wave. Now, wave 1 and wave 3 are in the same direction. Wave 5 is also in the same direction, and they move the prices up. Between wave 3 and wave 5 comes wave 4. This again takes down the prices and corrects the prices, which finally leads to wave 5. Now, this is where this up kick has ended, and now comes a bigger correction in the form of three waves, which are A, B and C. In these three waves also, wave A is an impulsive wave which moves in the downward direction. Wave B is a corrective wave which moves the prices back on the upside, and finally comes the wave C down, which again moves the prices. So what we can see is that a wave which has started from here, the prices went up to here, and then the price is corrected in a three-wave pattern. Now this correction or this retracement of prices has a percentage relationship for the total move of this wave. If I take this wave a little in a more detailed manner, what I see is that this first wave is again made up of 1, 2, 3, 4, 5. And the second wave is made up of three waves A, B and C. Now again we come to the upkick, that is the third wave, and this third wave forms again in a 5-wave structure 1, 2, 3, 4, 5. And the fourth wave again comes and it forms ABC. Actually ABC is usually not this simple. But for all learning purposes, to start with, we can call this as an ABC and the end of the fourth wave. And now comes the final fifth wave, which is again 1, 2, 3, 4, 5. So what you will see in all these price actions, wave 1, wave 3 and wave 5 are made up of 5 waves, whereas the corrections are made up of 3 waves, A, B, C. Fourth wave is again A, B, C. And once this 5 wave is over, what we see is a bigger corrective 3-wave structure A, B, C, in which A and C are both 5-wave structures. You can very clearly see 1, 2, 3, 4, 5. This ends A, and again B is a 3-wave structure which is A, B, C, and C again ends in a 5-wave structure 1, 2, 3, 4, 5. Now, if we have to see in a real chart, we will go to Adani Green chart of some time in 2018 to 2019. What we can see is this is a significant bottom, and we are seeing wave 1, wave 2, wave 3, wave 4 and wave 5. So this has ended one structure. It is followed by an ABC, which is A, B, and this whole down leg here is C. I hope I would have made some point in this video for you guys to like and subscribe my channel. Thank you very much for being with me.